Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Is this the beginning of maybe something bigger? Let's talk it over with Cameron Dawson, Chief Investment Officer at NewEdge Wealth, joining us here in our studios, Interactive Broker Studios. So good to have you, Cameron. Thanks for being here.
Thank you for having me.
Let's talk about 2026 for a minute. Let's look into the crystal ball. What do you see as the biggest challenges for this market?
Well, certainly as we get into 2026, we will be trading at high valuations with high earnings expectations. You've seen valuations just last week. They got over 23 times forward earnings. You have earnings expectations for mid-teens growth that's baked in already into S&P 500 estimates. And so that does create a high bar for the market to jump over. And I think the question will be is there further upside to earnings estimates because of things like AI productivity and AI investment? I think that remains a big question mark. And B, and this is a little bit nebulous, which is, do you still have a liquidity environment that supports even more margin or multiple expansion? Because if liquidity starts to recede, then 23 times looks pretty darn expensive.
Particularly with the Mag 7, still putting up some big numbers, but the growth rates are decelerating for the Mag 7. So that means the 493 need to really perform. How do you think about that?
Hope springs eternal in the broadening out trade. That was something that market participants were hoping for in 2025. This idea that you would see the 493 catch up even as Mag 7 decelerated. And what ended up happening is Mag 7 surprised to the upside and 493 surprised to the downside. And you didn't see that kind of catch up. But if we look at what's going on in 26, you have this law of large numbers that's pulling Mag 7 earnings growth lower. And of course, second derivatives matter in markets. So you have a name like Meta decelerating from 40% growth this year to a potential decline of about 2% next year. And you see that across the Mag 7 names. And this baking in of the idea of the broadening out really relies on the economy, A, being very strong, and B, these businesses being able to generate margin expansion. And they don't necessarily deserve the benefit of the doubt as we look at that 493 because they've continuously underperformed or disappointed on the earnings front over the last few years.
What are you looking at outside the AI trade? Because there's a lot of good stuff out there that we just don't talk a lot about because it doesn't garner the headlines.
Yeah, our equity portfolio manager, Jay Peters, has been absolutely salivating at some of the deals that he's starting to see where you have had names simply get left behind in the rally. Remember that September and October have been incredibly low quality rallies and incredibly narrow rallies. So a lot of junk moving higher very, very fast. And then the quality things that have been moving higher really just been in that Mag 7. So if you can broaden out the aperture into more value-oriented names as well as mid-cap names is where we're finding a lot of opportunities of parts of the market, again, that have just simply been left behind, but remaining very disciplined on those quality metrics, not chasing the junk, not chasing the dumpster dives, I think is incredibly important at this time.
The most powerful leadership in this market over the last 6 months has been low quality, junky, no profit, no revenue, speculative parts of the market. That reminds me of me in 1998, 1999, early parts of 2000s, the stuff I was selling when I was a banker. How concerned are you about that?
Yeah, it's been something that has definitely caused us to raise an eyebrow. We wrote about it over the weekend saying this is not sustainable. We looked at the rally that you saw in, for example, Korean fried chicken stocks in response
Korean fried chicken
There was a picture of Jensen Huang eating fried chicken.
It went viral.
And you saw this big, huge surge in Korean stocks. But if you look at the Kospi, it rallied 26% in October alone. So
talk about irrational exuberance.
Exactly. And the Kospi has oftentimes had these kind of casino capitalism types of moves. So it's a global dynamic. And why we remain really disciplined about quality is because what tends to happen is these names can go up a lot in a very short period of time, but they can also go down a lot in a short period of time. So from a portfolio perspective, they actually don't add any incremental return. And at the same time, they just add to volatility.
What do you like in terms of alternative assets? I mean, we saw Bitcoin have a little bit more volatility. I think it's back above $100,000 now, but fell to its lowest level since June. Gold continues to hang in there, like despite whatever's happening in the equity market. What do you like in terms of alt assets?
So when we think about Bitcoin, we see it really as a function of liquidity, which appears to be tightening at this time, given the fact that it is broken down, but also encapsulating some of these fears about dollar debasement, et cetera, which of course we know is the relationship with gold. I would add on to that spectrum of real assets, which we would consider gold and Bitcoin to be a part of. Infrastructure is something that we've really liked and added to portfolios. This idea that you can get high single digit, low double digit returns depending on how you're positioned and have something that's less correlated to equity markets. We like that in a world where equity markets could have lower forward returns. So that's been an area where it's certainly piqued our interest over the course of the last year and definitely into 2026.
What are we doing in the bond market here? I could sit there in a 2-year treasury, 3.5, 3.6%. That's not a bad way to make a living here. Do we stick there or do we take some credit risk here?
Yeah, I mean, continuously we keep talking about how this idea that credit really isn't compensating you for the risk that is potentially embedded in some of these businesses, and remaining higher quality in credit, doing active management within credit to be able to make sure that the right issues are being put into portfolios. And I think that high yield is what is causing us also to kind of look a little bit with a higher eyebrow at this market, because you've seen those spreads start to widen out. The thing to remember about high yield is that it is coincident and it is episodic. So spreads will widen out as there is pain in other places, not necessarily a leading indicator.
You know, we talk a lot about how this market is priced for perfection, and all you need to do is look at a stock like Palantir, right? Mm-hmm. I mean, by all metrics, that was a really good earnings report, yet they were punished. Yeah. What do you make of that, and what's an investor to do if you're looking for those quality names?
Yeah, a high bar is a high bar is a high bar. And the reality is that what might be baked into the sell side estimates that generates a beat and raise might not be being baked into the buy side estimates of people who actually own the stock and the forecast that they need to drive them to buy more. So we think that these reactions to good earnings reports is a reflection of A, buy side estimates are probably too high, and B, that fact that positioning is probably already very crowded in these areas. So valuations always do matter, but they matter eventually. And it's that catalyst of what causes a valuation to unwind that's a really key component of potentially driving these high-flying stocks lower.
All right, but again, we've got futures on the downside right now, looking at possibly back-to-back down days for Wall Street. Mm-hmm. Cameron Dawson, Chief Investment Officer, NewEdge Wealth. Thanks so much for stopping by the studios.
Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Jennifer Lawless joined us. She's a professor of politics and public policy at the University of Virginia in lovely Charlottesville, Virginia. Been there many, many times. Jennifer, talk to us about what you saw coming out of Virginia and New Jersey with Democratic wins, pretty solid wins as well. What did you take away from those governorship races?
Well, good morning. I think it was a good night for Democrats because both Abigail Spanberger and Mikey Sherrill had double-digit wins. They both exceeded expectations, and they were able to, especially in the case of Virginia, bring along down-ballot candidates. That included Jay Jones for Attorney General in Virginia, as well as flipping, as of right now, 13 House of Delegate seats. So there was momentum on the Democratic side. There was excitement for these candidates at the top of the ticket. And that's necessary, although not sufficient, if the Democrats are going to do well in 2026.
Professor, were these races, the sweep by Dems last night, is it a verdict on Trump's second term, do you think?
I think it's a mix of factors. Some of it is certainly dissatisfaction with Trump, but that's really among Democrats who were enthusiastic and independents who got out to vote. There's not much evidence that Republicans decided that they were no longer going to support the Republican administration. It was just they weren't that excited about their candidates at the top of the ticket, and Democratic turnout surged. So it was in part a referendum on the Trump administration. But the Democratic candidates who won last night were not only running as alternatives to Trump, they were also putting forward their own plans that would resonate with independent voters.
It's interesting, Jennifer, I'm a resident of New Jersey, and President Trump had a very, I'm going to say, low profile in this race here in terms of supporting the Republican candidate, Mr. Ciattarelli. What does that tell you, if anything?
Well, I think the Trump administration and the Republican candidates' campaigns are aware of the liabilities associated with Donald Trump in blue states. There's no question that Trump overperformed expectations in New Jersey in 2024, but it's important to keep in mind that Kamala Harris didn't really campaign there. So I think the Republicans thought that they were stronger in some of these blue states than they actually were, simply because there was one presidential candidate campaigning there last year and not two. And the outcomes in both Virginia and New Jersey suggest that Donald Trump can be a liability, especially when Democrats are excited and energized about their own candidates.
Professor, I want to step away from the elections for a moment and just talk about what's going on with the Supreme Court today. Going to hear arguments over Trump's unilateral decision to impose these sweeping global tariffs. What's at stake here besides possibly trillions of dollars in refunds needing to be given back?
This is one of the cases where we're really going to see what the Supreme Court thinks about presidential power and executive power and the ability of the president to engage in unilateral action. If we've learned anything over the course of the last several months, it's that the Supreme Court seems to be willing to grant Donald Trump more in the way of authority than previous presidents thought they were entitled or sought. So this is just one more example of that. We'll see what happens.
So given what we saw yesterday, just kind of the elections here, Professor, what are the takeaways for, I don't know, the Democratic Party writ large, the Republican Party writ large? Are there lessons to be learned here?
I'm always a little bit leery about using a couple of races to forecast what could be done in the future, but I do think there are a few lessons. The first is that despite the fact that the overwhelming majority of the American people are turned off to politics, are disgusted with what's going on, they voted in record numbers yesterday, and that bodes well for the Democrats. It suggests that even though the Democrats have been demoralized and have felt that they haven't had a win in a long time, when push came to shove, they turned out with enthusiasm and they won. The second take home, I think, is that different kinds of Democratic candidates win in different kinds of places, which is not rocket science, but it's something that we often forget. And so the kind of Democrat that can win in New York City does not look like the kind of Democrat who can win statewide in Virginia. But that doesn't mean that Democrats can't win in both of those places. And that should also be encouraging for the Democratic Party heading into 2026. And the final message, I think, is that when Donald Trump is not on the ballot, Republicans have a tougher time. He's really what motivates turnout among Republican candidates, and he's not going to be on the ballot in 2026. So I think last night should have injected some enthusiasm into the Democratic Party. We'll see what they do with it over the course of the next 12 months.
All right. Very good. So I guess one final question here, Monica, is just simply, who is the face of this Democratic Party here? It doesn't seem to be Mr. Schumer. It doesn't seem to be even Hakeem Jeffries. Might it be one of these folks who won yesterday?
It's unclear. There was definitely a generational shift yesterday. All of these candidates are relatively young, some younger than others, but a lot of them have not been career politicians either. They've been elected just for the last 3 or 4 cycles. And so I think the face of the Democratic Party might be just fresh faces and new ideas and new energy. And as long as Jeffries and Schumer embrace that, I think that the 2026 elections could go better than they probably anticipated a week ago.
And shutdown here, who's paying the cost here? I mean, we're in day 30 something, or I can't even keep track. Is there anybody paying a cost here for these shutdown?
The American people are clearly paying the cost. It seems, based on last night, that at least in terms of the Virginia results, federal workers broke for Spanberger. And it seems like they are blaming the Republicans. When the Republicans have unified control of government, when they control the House, the Senate, and the White House, it's hard not to blame them for the shutdown. And it seems that, at least in terms of the ballots cast yesterday, they are bearing the brunt.
All right, Jennifer, thank you so much. We appreciate that. Jennifer Lawless, professor of politics and public policy at the University of Virginia. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Danielle DiMartino Booth joins us. She's one of our faves. She's a CEO and Chief Strategist at QI Research. She looks at data that I don't even know where it comes from. And, she doesn't rely upon the government stuff. She gets her own data sets. I have no idea where that comes from, but it's really, really smart and really helpful here. Danielle, thanks so much for joining us here. Again, with the dearth of economic data out there, for those of us that are trying to figure out where this economy is going, what are you looking at? What are you seeing out there in this U.S. economy?
So, I think the good news a month ago is that QI Research was always looking at alternative data sets. There was a Reuters poll that came out that said that 89% of economists did not trust the official data prior to the shutdown. So I don't think that I'm necessarily alone. But anyways, to answer your question, we look at NewEdge, which is an alternative to Challenger. They use kind of big data to scrape headlines. For the month of October, we learned that it was almost 155,000 job cuts that were announced. And that helps to kind of put into context what we heard from ADP this morning, because these were large companies making big job cut announcements. And yet what we saw for the month of October is that ADP job creation was exclusively with the largest companies. Of course, you count an employee as being on the payroll until their severance runs out. So we know that that's kind of a ticking time bomb. We follow Google Trends. Every day, Americans search or don't search to file for unemployment. And when you look at that, the 2025 trend really has gone off of what we saw in 22, 23, and 24. We also follow individual state warn notices, which they have to provide to workers when they're going to be laid off. And right now, in the aggregate on a nationwide basis, warn notices are running at the highest pace since September 2009. So the data's always been there. You just have to know where to look.
And what does all this mean for the Fed and that December meeting, in just a few weeks? Are we going to get one more cut, do you think, before the end of the year?
Well, I think given the headlines that we've seen subsequent to Powell being at the podium, in the beginning, the odds of a rate cut ticked down to like 55%. Now, as of today, we're back up at 70%. And I think that that's because we're not seeing, especially when you hear from companies like Kava and Chipotle, we're not seeing companies able to pass through higher costs to their end customers. And that means that there's not going to be as much pressure on the Fed's inflation mandate as there is going to be on its employment mandate. And I think that that's why we've seen odds of a subsequent December rate cut hover around this 70% level. And Jerome Powell's never defied markets when it's been north of even 50%. So there is the presumption in the markets that we will see this next rate cut.
Danielle, so we've seen a lot of, headlines on layoffs and from companies we all know and people can relate to. Is that headline risk, or does that really reflect, oh boy, we've got a labor market that's at the margin really kind of struggling here?
Well, I think it's the latter of the two. Yesterday, we heard from TripAdvisor, American Airlines, IBM, and every day we seem to get a new laundry list of companies. And I think that it's indicative that it's more endemic. Kind of at the beginning of the year, we had this so-called low hiring, low firing situation. And Powell warned when he gave a speech a few weeks ago that if we see a continued lack of hiring, but also see a pickup in firing, that really does change the construct. It's going to change the Fed's thinking. And I think that that's where we are at this point.
Danielle, I just want to get your thoughts on AI, because we seem to be doing that every day with our guests. And earlier we had Brad Conger on. He's a chief investment officer over at Hurdle Callahan. And he said that he thought the AI data center boom was a big, huge bubble. He went on record saying that. What are your thoughts on that?
Well, I'm not an expert in this field, but I would have to say that Bain Capital would have agreed just yesterday when they came out and they said that they were not going to be joining with other large investors in trying to pump up this boom. We also know, this is the day after Election Day. We also know that a lot of communities are pushing back against these data centers being in their backyard because one of the two main sources of inflation are food prices and electricity prices. But yes, when the United States has 10x that of Germany or China in terms of the number of data centers, it brings you back to the days of fiber optics and makes you question, is this fiber optics 2.0? I would agree with your guest earlier today.
Yeah, and I remember those fiber optic days when that was kind of the bomb, and telecom stocks were going crazy. Danielle, on the inflation front here, you know, the headline numbers, they're still a little bit above, obviously, where the Fed would like to see it. But boy, I kind of feel like we're dodging a bullet here on this tariff inflation here. Is that right, or is it still perhaps to come?
You know, listen, to your point, ISM came out a few days ago and said, we are no longer seeing the effect of tariffs in our price structure. Wow. Manufacturers, factories are no longer feeling these tariffs. They've mainly come through the pipeline. And in fact, what we're seeing now is one company after another saying they've got too much inventory on hand because they had a lot of stock building going on into the tariffs, and now they're trying to work that down. And we're hearing from one company after another, especially in the housing space, that they've simply got too much stock on hand right now, and they're having to discount to get rid of it. So you're actually seeing the opposite effect on inflation due to tariffs.
Do you think also that just they've been successful negotiating with other countries, or with, you know, whatever it is they have to pay at the ports? I mean, there's got to be some heavy duty negotiating going on here. It's hard to believe they're absorbing all the cost.
Well, yes. And you hear one company after another say, we have found alternatives. It's like, I'm finding alternative data sets every day. Companies are finding alternative suppliers if need be. And I think that is something that is probably a healthy development, because you always want to be able to, whether it's hedging your portfolio or hedging your supply lines. And I hope to see this trend continue going forward, because I think it could have been pursued more aggressively after COVID, and it was not.
Danielle, thanks so much for joining us. We always appreciate getting a few minutes of your time. Danielle DiMartino Booth, CEO and Chief Strategist, QI Research, one of the smarter folks we chat with. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Let's do some newspapers right now. It's that time of the day. We do it with Lisa Mateo. What do you got for us, Lisa?
Okay, I want to start with this in the Washington Post. This is a sign that more college students are worried about getting a job in this economy. This is an analysis of federal data. They're choosing more double majors, which is interesting. They have nearly 5.4 million credentials, which are degrees or certificates. They were earned by the 4.8 million college and university graduates in 2023 and 2024. So that means about 12% of graduates earned more than one credential. That was compared to 6 to 10% years ago. So you see there's more of them doing it. And experts are saying, you know what, the students think more is more, because there is a study that shows graduates who had two majors, they're 56% less likely to be laid off and have their pay cut. So these are kind of the decisions that students are making. I had a double major. I don't know,
you're
that
special.
was back in the day.
What was your double major?
What was it?
Journalism communications.
Very closely aligned. Nice. But you know what? For me, it would come down to, you know, also how much more money is that going to be? Most colleges will not charge you for the double major, because it still falls within, I guess, however many credits you need to graduate. Yes. But if it means summer classes, if it means more money, you might want to rethink that. College is expensive enough.
For me, it took a little summer class, and it took like a few more classes to take. But 4 years.
There
got
you
it
go.
done. You got to do.
And here you are.
to do
Exactly.
it.
All right. Burger King.
Okay. Yeah. So we talked about McDonald's earlier, right? So now we're going to hit Burger King. It's not about the burgers and fries, though. It's about the change that they're giving to customers. This was in the Wall Street Journal. It actually says that it's struggling with pennies. And you mentioned this before. They're wondering what's going to happen when they run out of them, because most of their customers still pay with cash over at McDonald's.
Really?
So one operator is saying, you know what? I have 30 boxes of pennies squirreled away. I hope it makes me go through 2 months at least. And President Trump, has that order stopping production of new pennies. So it has all these, folks scrambling. So what are they doing in the meantime? You have cashiers who are having to get used to split second rounding. It's all this math at the counter that's trying to be figured out.
They're just going to round up. McDonald's is rounding up. Burger King's going to round up.
Well, I go for breakfast and/or lunch on Saturdays in my town. Cash only. And you'd be surprised. Now, for all the locals that go there, we all know it. And we're all prepared for it. But for the tourists that come in, they're like, what? Cash? I mean, where do I get cash? Venmo, they're freaked out because they have to deal with cash. So
it's so true.
It's a dying art.
It's so true. I mean, sometimes you go, but usually they have the big sign that says cash only.
Right, exactly.
To warn you. Okay, so this last one, this has a panic setting in for moms and dads, okay? K-pop Demon Hunters toys may not be here in time for Christmas. They don't know what to do with themselves. They're struggling. How are we going to get these toys? They're not going to get them. The Netflix, it's led to this high demand for merch. You have like action figures, dolls, plushies. The kids want them all. The reason why it's not happening, it's because of the time required to produce, ship the consumer products. But no one thought it would become such a hit. And these things take like a long time in the making, to start. Like Netflix was pitching retailers about the film years ago. And they said, nah, we're not interested, and now they're regretting it.
Hasbro, Mattel, they're scrambling to get these items out there. So I wonder what the big thing is going to be for Christmas then.
That's a good question.
What's the big toy? I don't know. My kids are too old now.
It's electronics for our house. I'm
not zoned in on that anymore.
They get a pat on the back. My kids these days. They're too old. What's the demo for these K-pop things? Is it teenagers? Is it younger?
It's younger and teens too. I kind of watched it over the weekend with my daughter.
And what do you think? I haven't seen it yet.
It was kind of a fun movie to watch. It's very uplifting and you're kind of dancing to the music. But I do have to say it's good. But for those kids who wanted these toys, they're going to be a little bit upset about it. It's not going to be in the stocking
Something
this
for
Christmas.
them to strive towards,
All right.
Okay.
Very good. All right. That's it. Newspapers. Lisa Mateo, you know it. You love it.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.